Valuation process. How do you start valuation of an asset or a company or a share or a liability? The process for valuation starts from understanding the purpose of valuation. That is step number one. So, whenever I get a new assignment for valuation, the first thing that I do is to find out what is the purpose for which the client wants the valuation to be carried out. We will discuss what are the purposes, because the purposes can be many. The purpose can be a corporate transaction. The purpose can be for the purpose can be financial reporting. The purpose can be for litigation. The purpose can be for the income tax. So the purpose can be settlement of a dispute. There are many purposes for which a person or a company or an organization may decide to value their assets and liabilities. So the first point in the process of valuation is understanding the purpose. At number two, you have identification of premise of valuation. Now, what are the premises of valuation? Now remember, there are only two premises of valuation. Primarily, there are only two premises of valuation. The first premise is the premise of going concern. That means what? That means you can value a business as a going concern. And the second premise is of liquidation. So that means you can value this business on the basis of assuming that this company is going to close down. So there are only two primarily two premises. The premise number one is going concern, and premise number two is the liquidation. And I'm sure you can very easily understand the valuation in case of a business as a going concern is going to be much more, and the valuation in case of the premise of liquidation, it is going to be far too less, because now this business is expected to close down, and therefore whatever you will realize is only equal to the amount that you will realize from the sale of the assets minus the expenses that you will incur on the sale of those assets. So that is step number two, identification of the premise. And depending on the purpose for which you have to do the valuation, you can very easily figure out as to what premise do I need to use. Do I need to use the going concern premise, or do I need to use the liquidation premise? Now, after identifying the premise of valuation, then you come to the determining the standard of value. So,
Small doubt, sir.
yep, please go ahead.
Sir, yes, sir. Sorry to disturb you,
No,
sir.
no,
Sir, this identifying the premise of valuation, I understood, sir, going concern and liquidation. But what is the exact meaning of premise, sir?
is the
General
basis.
meaning, premise
Basis.
means what? What is?
Premise means basis. What is the basis on which you intend to do the valuation? So the basis can be on going concern,
Thank you, sir.
and the basis can be liquidation. So that is the meaning of premise in case of identification of the premise of valuation.
Thank you, sir.
Yeah, good. And then you come to the step number three, which is determining the standard of value. So what is the standard of value that you need to consider? And the standard can be number one, fair value. The standard can be fair market value. The standard can be specific value. The standard can be the intrinsic value. So primarily there are four standards of value, and the first is fair value, the second is fair market value, the third is specific value, or also known as investment value, and the fourth is the intrinsic value. And this is what we need to understand. What is fair value? It's very simple. What is fair value? Something which is fair. What is the meaning of fair? That means neither the buyer nor the seller is under any kind of coercion or pressure or stress for doing the transaction. Both the buyer and the seller are entering into the transaction willingness and knowing fully well as to what they are buying or what they are selling and what they are paying and what they are receiving. That is fair value. Then you have so for example, if you have to sell your car second hand your existing car to somebody. So what you do, you speak to some of friends of yours and tell them that I want to sell off my car. So one of the friend that you have will get in touch with you and he would say, yes, I am prepared to buy your car. So you say, all right, come to my house. So your friend comes to your house, he brings a mechanic also. You show him the car. The friend asks the mechanic to check the car. So mechanic does the checking of the car and he comes and tells you that you can buy this car in 200,000 rupees. So you tell the friend tells you, the mechanic tells your friend that he can buy this car in 200,000 rupees. So your friend comes and tells you that I am prepared to purchase this car for 200,000 rupees. And you say, all right, I am willing to sell it for 200,000 rupees. So both of you agree and the transaction is done. Now this is a fair value. Why this is fair value? Because there is no other consideration in this transaction. So what the friend is getting and what he is paying, that is the only thing which is getting exchanged between you and the friend, and there is nothing else other than these two, and therefore this is fair value. You are doing it willingly, he is doing willingly. You are you are not under any kind of pressure, nor the friend is under any kind of pressure. This is fair value. Then you have to understand the fair market value. Now what is fair market value? How do you differentiate fair market? How do you differentiate fair market value from fair value? And the answer of course is very simple. The difference between the fair value and the fair market value is of market. Meaning what? Meaning uh, just now you did a transaction of selling your car to a friend of yours. Now what you did here, you spoke to some of your friends and this is how you did the transaction. In case of fair market value, what you do, you don't speak to friends of yours. You upload the details of your car on Car Dekho or on Quicker or on OLX. So you put your details of your car on these portals, and now somebody on the other side is also putting their requirements of buying the cars, and they look at your details and specifications, and then they decide the price. So what is deciding, what is the price getting decided? The price is getting decided through a market exchange. So the portal is that market. So now the price is getting decided by the portal, and this price is known as fair market value. So you can sell these shares to a friend of yours, then it is a fair value. You can also buy or sell the shares through the stock market, and that becomes the fair market value. So when the price is decided not by the buyer and the seller as such, when the price is decided by the market, that becomes the fair market value. So this is a value of standard of value, which is market value, which is the fair value, and number two, fair market value. Do you get this, Sugmar?
Yes, sir, understood. Completely understood, sir.
Good. The third is specific value. Third standard of value is specific value. And what does it mean? It means there are certain assets which have a specific value for a particular buyer, and that is known as specific value or investment value. We will discuss this example little later when we go further. The fourth thing is intrinsic value. Now, what is intrinsic value? Would you like to tell me what is intrinsic value?
Sir, intrinsic value, it is like uh, the meaning of intrinsic value. We want to know what is the, like it is ultimately after liability to, I mean, through net assets minus liability, what is left out to the equity shareholder as a per share value. The worth, we can say again, what is the equity shareholder for the worth when per share. That is a
Okay, very good. Now, intrinsic value, though a lot of people have a lot of confusion about intrinsic value, and they think that intrinsic value is something which is highly subjective. Intrinsic value is something which is very difficult to measure. But on the contrary, intrinsic value is the most objective of all the values that we are talking about. So what is intrinsic value? Intrinsic value is nothing but present value of all the cash flows that can accrue from the use of that asset. That is intrinsic value. So, and it is as simple as that. That is intrinsic value. Finding out present value of all the future cash flows accruing from an asset, summing all of them together, and the amount that you arrive at is the intrinsic value. So that's your step number 3, and that's where you determine what is the standard of value. Then you come to the step number 4, and that is EIC analysis. Now, what is EIC analysis? It is very simple. It looks something very complex when you look at EIC analysis, but the meaning of EIC analysis is very simple. Remember, when we have to do the evaluation as as a valuation professional, obviously we need to have a very good understanding. A very good understanding of what? For being a good valuation professional, for being able to find the real fair value of an asset, we really need to have good understanding of EIC. What is EIC? EIC is economy, industry, and company. Only when we have good understanding of economy, industry, and company, then only we would be able to arrive at right kind of valuations for different assets for which we may be required to do the valuation.
It's like top-down approach, sir.
Yeah, so that means it is not top down approach, Sugumar. This is EIC is economy. So as a valuation professional, you need to have a good understanding of how is the economy doing,
Okay.
because ultimately value of a company will also be dependent on the stage of economy. So if the economy of a country is doing well, so if the economy of a country is doing well, there is a full possibility industry will do well. If industry is doing well, there is full possibility the company will do well. And if the company is doing well, I am sure you can understand this company will get good valuation.
Yes.
So what you do EIC analysis. So in case of EIC analysis, what you need to do, you need to build your understanding about the economy, all aspects of economy, more so the macroeconomy, right? The macroeconomy that you need to understand. Then you need to have good understanding of the industry. So when you are doing the valuation as a valuation professional, you will get assignments for doing valuation of different kinds of assets. So those assets or those companies will belong to different industries, and therefore obviously you will need to have a good understanding of different industries. Or maybe when you get an assignment belonging to a particular industry, so you will need to make extra efforts to have a good understanding of that industry at that time, and that's your industry analysis. And there are a lot of models available for doing the industry analysis, for the economy analysis. Like you have a SWOT analysis, which is a model. You got pest analysis, you got pestle analysis, and you got Boston Consulting Matrix, and you got McKinsey 9-box model. So these are the different. You got Michael Porter's 5 force model. So these are the different tools available for the purpose of doing the industry analysis for coming at the appropriate valuation. And then you come to the C. C is for company. So that means obviously if you have to do the evaluation, you should also be able to analyze the company. And when you talk about analysis of company, what it would mean number one, you need to obtain good understanding of the background of the company. So when I say background of the company, that means everything about that company you ought to know. What is the product? Where the company is situated? Who are the promoters? Does the company belong to a particular group, or it is a company by itself? What are the markets? Which are the geographies in which the company is operating? Who are the suppliers of the company? Who are the customers of the company? Is the company in a very competitive market, or the company in the monopolistic situation? So all those factors you will need to find out, and for doing the company analysis, that is the background information. Then you will also need to do the financial statement analysis. You will also need to do the financial analysis of the company. And for doing the financial analysis of the company, you will need to find out the profitability. So there are different ratios that you will need to calculate: the gross profit ratio, the EBITDA ratio, the EBIT ratio, EBT ratio, EAT ratio. So all those you will need to calculate, and you will also need to calculate the return on equity ratio, and you will need to calculate the return on capital employed ratio. So these are the ratios you will need to do for profitability. Then you will need to do find out the liquidity ratio, for which you will do the current ratio or the quick ratio for finding out the liquidity of the company. Then you will need to do the efficiency ratios, and for the efficiency ratios you will need to calculate the turnover ratios: sales divided by the fixed assets, sales divided by the total assets, sales divided by the current assets. Now this is what will give you an idea about the efficiency of a company. And after the efficiency, you will need to calculate the leverage ratio, financial leverage ratio. And for the financial leverage ratio, you will need to calculate something which is known as debt equity ratio. So how much is the debt that the company is having, how much is the equity that the company is having, what is the ratio between the debt and equity. So higher the debt equity ratio, riskier becomes the company. Lower the debt equity ratio, that means so much less is the financial risk of the company. And that's your stage number 4 in the valuation process. Now after this you come to the fifth stage, and that is where you look at the approaches for the valuation, and we will look at this in detail as we move on. So you will need to find out the approaches, and there are 3 approaches for the purpose of valuation. This is an income approach, and there is a asset approach or the cost approach, and then there is a market approach. And under these different approaches, there are different methods. We will look at them one by one. So once you complete all these 5 steps, then they would automatically lead you to the determination of value. So this friends is the process for valuation of any asset for which you will be required to do the valuation.